The US housing market is in serious trouble in 2024. Check this out, folks. I'm going to show you the head economist for Realtor.com who came on to Fox Business recently. Listen to what she had to say.
You know, it's interesting, Danielle, the median age of all home buyers has increased from 31 in 1981 to 49 this year. It's remarkable. I mean, you know, to your point earlier, are younger people just priced out of the market?
I think it is very difficult for young people to enter the market right now. Many of them are priced out, and if they're not priced out, they have to wait longer to get to that age where they've amassed enough funds for a down payment that they can compete with equity-rich existing homeowners in the market. I think also some awareness about the options that are out there today. So for potential first-time homebuyers who happen to be active duty military or veterans, they do have some advantages in the form of VA loans, which allow them to make zero down payments, but many potential veteran buyers don't.
All right, she goes on to say that the reason why that we don't have more home sales is because active duty actually aren't aware that they can go get a VA loan, which is silly. But let's go to the heart of what she just said. The median age of home buyers, look at this, folks. The median age of all buyers this current year is 49. And then the first-time home buyer is 35. The repeat buyer's median age this year is pushing 60. So how in the world, folks, you can't just have the slowness of how fast things are appreciating. So the big question now in our entire economy, the big question across all these talking heads, the outlets are saying, hey, you know what? Jerome Powell did not cut rates fast enough. We are going to careen into massive recession because of the austerity measures are going to overtake us in 2024. You got to understand this too. All the people in the markets right now that are dumping cash into the market thinking and planning for the feds to actually cut interest rates. You have to understand that if that is happening, if the Fed cuts the rates, that on its face means that we're in serious economic issues. The Fed is not going to cut rates unless there are major problems. Now, you can see right here, the market data came out today is pointing to the fact that unemployment is going up. So we're right now on the unemployment rate for the national level is 3.9%. Florida is obviously better than that. But in terms of the national marketplace, over the past 5 months, since July, we've gone almost half a percentage point. We're right inside. We're 0.4% of an entire point from actually seeing unemployment climb half a point in a matter of 4 months. You can see here that all the labor market data that just came out today was really bad for the economy. According to the BLS, the largest decrease in job openings was in healthcare. So there was almost 250,000 jobs lost in healthcare. Finance and insurance lost 168,000 jobs, and real estate rental and leasing lost almost 50,000 jobs on this last run. The other thing that we're seeing is that the amount of jobs per opening. Okay, so you know if you're unemployed and you're looking for a job, the amount of openings per person is starting to get narrow. In fact, it's finally on its track to what we call normal. But right now, there's just 2.2 million more job openings than actual unemployed workers. Okay, and that's one way of looking at it. Take a look at the chart that actually shows how many job openings there are per worker. You can see that the ratio of jobs per the unemployed, it's in free fall. Like the amount of people that actually have the ability to quit their job and be rehired, it's a slim reality. So a lot of the worker strength, remember, I've been telling you on this channel that before things get bad, they're going to get stale. They're going to slow down. You know, they're not going to go into really bad negative territory in terms of you're seeing actual hourly wages roll back overnight. You're going to have a situation where a person that's actually in the job market isn't going to be able to just go out and say, I'm going to quit here and go across the street. That opportunity does not exist. So the actual percentage of quits is also slamming down, where people are very, much more cautious in terms of quitting their job in order to cross the street and get a job somewhere else. So across the board, you're actually seeing a lot of the job numbers just are not good. Here's a quits number, by the way. You can see that the trend is just plummeting, where people are basically job hopping and trying to get a better job. And the fascinating thing, folks, look at this. I wasn't aware of this, but over the past 5 months, the BLS, the Bureau of Labor and Statistics, the Biden administration has been revising the numbers down after every report for 4 out of the 5 past months. So by the way, the aggregated total of all those changes is close to 1 million jobs that they said we had that we did not have. So meaning they were printing them originally and then they changed them. And you got to understand, this is through summer months when the Fed actually went through and cut rates after this data. So you're seeing a lot of this craziness in the market. Now, look at the people the ones that are like pressing the Fed. You got Jeremy Siegel, who is an economist. He actually teaches finance at Wharton School. It's the same business school that I believe Trump went to. And you know, a dear friend of mine loves this guy, and this guy has been on CNBC forever decrying how bad the economy is going to be into 2024 because they did not cut rates fast enough, that they've held on too long. Listen to this from yesterday.
Unemployment rate goes above 4%, we trigger rules that have said that unemployment rising 0.5% from its low mean that the likelihood of recession really increases dramatically. So we're not totally out of the woods on that score yet.
Well, I just wonder there's what you want to happen and what you think is going to happen. You think the Fed is going to have we saw what happened on the way into this in terms of staying out of raising rates for too long. Do you think they're going to stay too long? You think they're going to be stubborn about cutting rates?
That's the worry. I mean, they were way too
Listen to this.
late on raising. Are they going to be, I hope at this meeting that Chairman Powell will finally acknowledge we're talking about it, not that we're doing it. But we're talking about, which you remember in the November meeting, he actually ruled, we're not even talking about lower. They should be talking about it, not that they're doing it.
So basically the war cry is this, is like, hey, look, things are so bad. And this is a person who's heavily invested into long-term markets. So I looked up Jeremy Siegel. I looked at what he teaches. This is a guy who, all intents and purpose for everything that he wants to see happen. His view of the marketplace is that once we stall things from going up so fast, we need to chill out, okay? So there's a school of thought that says, never mind the cost of many, many things went up 80%, okay? Don't worry about lowering and deflating the price of, for instance, our housing stock. So if you look at our housing stock, it's gone straight up with the printing of money, always does. So, if you look at the last 20 years at the money supply, how the Federal Reserve, the central banks, as they ease credit and they make it cheaper, then people spend more money and people borrow more money and people inflate the cost of things. And so essentially the big narrative now is like, hey, look, just isolate what you've done. Okay. You've moved the value of everything overnight, like 70, 80%. Okay. Your home's gone up 2-3-fold. And so all we need to do is stop things from going fast from here. But to these people, the idea of a a soft landing means that you just stop. It doesn't go up from here and it stays where it is. It stays massively overly inflated to the degree that people cannot afford it. Okay. Look at the chart again. Okay. Do we want a housing economy where the average age of a person buying a slightly bigger house, they have to become 60 years old before they get out of the first condominium purchase they bought? Okay? Like, do you understand the reality of like the idea of keeping things where they are and just, the bizarreness of this is that, the talking heads from Wall Street, they want the fact that we've printed a ton of money. The cost of asset prices have gone berserk. They've gone ridiculously high. Depends on what it is. And I grant you, some things have come down. But there's a whole lot of things really that stem from the unemployment market. And the Fed knows this. The Fed knows that right now you have an average move-up buyer at 58. You have an entire housing market that doesn't move. And again, you're seeing it shift. Like I could show you data like this. This chart right here, by the way, the blue in the middle represents all the mortgages in America that are 3 to 4% range. Now you see this is the light blue, the section where my cursor is. Underneath that, you can see that there's a huge section of houses that are under 3%. But you can see that there was a peak of people below the 3% mortgage, or below 4% rather. These are 3 to 4%, under 3. Under 4% is dropping. So even over time, the people that we say won't sell are selling. You can see it quarter after quarter. This area of the chart up here is 5%. You know, it's actually 4.5, 5, 6, and over 6. So you can see that over time, quarter after quarter, the percentage of people that are now above 4 and 5% even is starting to grow. The reality is, are we okay with having a marketplace that's froze up? Is that the healthy norm that we're coming to? We're basically going to bake in all of this printed money, all this digitized cash that inflated the value of everything. And honestly, if you listen to Jeremy Siegel yesterday, he's stressed because Jerome Powell's not even talking about it. There was a former Fed chair that was on after Jeremy Siegel even on CNBC, and he's like, look, like there's not enough healthy economics markers. There's not enough looseness, right? You got to actually have things return to where a huge bulk of the people can actually afford to survive.